Hello, my dear students. A very warm welcome to all of you in Shri Jayendra Rank Zone. I am your friend and mentor for the subject Principles and Practices of Accounting. In this lecture, we'll begin with Accounting Chapter 8, Unit 1, that is Introduction to Partnership Accounts. Let us begin. This is Lecture 1, Chapter 8, Partnership Accounts, and we'll begin with Introduction to Partnership Accounts. Learning Outcomes. After studying this unit, you will be able to understand the provisions of Indian Partnership Act 1932 and Limited Liability Partnership Act 2008. Understand the features of partnership form and need for partnership deed. You will understand the points to be covered in the partnership deed regarding accounts. Learn the technique of maintaining profit and loss appropriation account. Familiarize with the two methods of maintaining partners' capital account, namely fixed capital method and fluctuating capital method of maintaining partners' capital account. Note that the capital account balance as per fluctuating capital method is just equal to the sum of the balances of capital account and current account as per the fixed capital method. Learn how to arrive at a corrected net profits figure which is to be taken to profit and loss appropriation account after the rectification of errors. Rectification of error may be necessary to arrive at a net profit of partnership and preparing profit and loss appropriation accounts. Learn that interest on capital and drawings, salaries and commissions are to be shown in the profit and loss appropriation account and not in the profit and loss account. Also, learn that drawings by the partners will not appear in the profit and loss appropriation accounts. Overview of the unit. Business carried on by all or any of them acting for all. Unlimited liability of the partners, these are the features. An association of two or more persons involve partnership. Sharing of profits and losses of the business. Existence of a business. An agreement entered into by all persons concerned known as partnership deed. Accounts of partnership firm. We'll learn to prepare trading and profit and loss account and balance sheet, profit and loss appropriation account, capital accounts of partners. Capital accounts is of two types, fixed capital accounts or fluctuating capital account method. Introduction. Why partnership? An individual, that is sole proprietor, may not be in a position to cope up with the financial and managerial demands of a present day business world. As a result, two or more individuals may decide to pool their financial and non-financial resources to carry on a business. The preparation of final accounts of sole proprietor have already been discussed in chapter 6. The final accounts of partnership firm, including the basic concepts of accounting for admission of a partner, retirement of a partner, death of a partner, has been discussed in succeeding units of this chapter. Definition and features of partnership. As per section 4 of Indian Partnership Act 1932, partnership is the relation between persons who have agreed to share the profits of a business carried on by all or any of them acting for all. Features of partnership. First, existence of an agreement as per section 5 of the Indian Partnership Act 1932. The relation of partnership arises from contract between parties and not from status, as it happens in case of HUF, that is Hindu Undivided Family. A formal or written agreement is not necessary to create a partnership firm. Business. A partnership can exist only in business. Thus, it is not the agreement alone which creates a partnership. A partnership comes into existence only when the partner begins to carry on a business in accordance with their agreement. Section 2B of the Indian Partnership Act 1932 only states that business includes every trade, occupation, and profession. Next, sharing of profits. The persons concerned must agree to share the profits of the business because no person is a partner unless or she has the right to share the profits of the business. Section 4 of the Indian Partnership Act 1932 does not insist upon sharing of losses. Thus, a provision of sharing of losses is not necessary. Mutual agency in case of partnership, it means that the business is to be carried on by all or any of them acting for all. Thus, if the person carrying on by the business acts not only for himself but for others also, so that they stand in the position of principal and agents, they are partners. Number of partners. Minimum number of partners is 2. Maximum number of partners as per section 464 of the Companies Act 2013, no association or partnership consisting more than 100 members of persons as may be prescribed shall be formed for the purpose of carrying on the business. Rule 10 of the Companies Incorporation Rule 2014 specifies the limit as 50. Thus, the maximum number of members in a partnership firm is 50. I believe you understood. Let us continue. Limited Liability Partnership LLP. The Indian Partnership Act 1932 provides for general form of partnership which has inherent shortcoming of unlimited liability of all partners for business debt and legal consequences, regardless of their holding or profit sharing ratio. As the firm is not a legal entity, general partnerships are also jointly and severally liable for tortious acts of co-partners. In case of liquidation, personal assets of the partner can be liquidated to meet the liabilities of the firm. With the growth of Indian economy, the role played by its entrepreneurs as well as the technical and professional manpower has been acknowledged internationally. Entrepreneurship, knowledge, risk and capital may be combined to provide a further impetus to India's economic growth. In the background, a need has been felt for a new corporate form that would provide an alternative to the traditional partnership with unlimited liability, unlimited personal liability on the one hand, and the statute-based governance structure of the limited liability company on the other. This would enable professional expertise and entrepreneurial initiative to combine, organize, operate in flexible, innovative and efficient manner. The government felt that the Indian professional increasingly transacting with or representing multinationals in international transactions, the extent of the liability they could potentially be exposed to is extremely high. Hence, in order to encourage Indian professionals to participate in the international business community without apprehension of being subject to excessive liability, the need of having a legal structure like limited liability partnership LLP is encouraged. Thus, in convergence towards global scenario, Limited Liability Partnership Act 2008 was introduced. Next is the Limited Liability Partnership LLP is viewed as the alternative corporate business proposal that provides the benefits of limited liability but allows its members the flexibility of organizing their internal structure as a partnership which is based on a mutually arrived agreement. The LLP will be separate legal entity liable to the full extent of the assets, with the liability of the partners being limited to their agreed contribution in the LLP, which may be tangible or intangible nature, or both tangible and intangible in nature. No partner would be liable to account for the independent or unauthorized actions of other partners of being their misconduct. The liability of the LLP and partners who are found to have acted with intent of defraud creditors or for the fraudulent purpose shall be unlimited for all or any of the debts or other liabilities of the LLP. I believe you understood till here. The main benefit of the LLP is that it is taxed as a partnership but has the benefits of being a corporate, or more significantly, a jurisdictional entity with limited liability. An LLP has the special characteristics of being a separate legal personality distinct from the partners. The LLP is a body corporate in nature. The limited liability partnerships in India were introduced by the Limited Partnership Act 2000, Limited Liability Partnership Act 2008, which laid down the law for the formation and regulation of limited liability partnerships. Definition of LLP. Section 2 of Limited Liability Partnership Act 2008 defines limited liability partnership as a partnership formed and registered under this Act, the Limited Liability Partnership Act 2008, and Limited Liability Partnership Agreement means any written agreement between the partners and the limited liability partnership, or between the limited liability partnership and its partners, which determine the mutual rights and duties of partners and their rights and duties in relation to the limited liability partnership. I believe you understood. Next is non-applicability of the Act of the Indian Partnership Act 1932. Save as otherwise provided, the provisions of the Indian Partnership Act 1932 shall not apply to a limited liability partnership. Limited liability partnership is governed by a separate act, that is Limited Liability Partnership Act 2008. Minimum number of partners is in case of a LLP. As per the LLP, any individual or body corporate may be a partner in a limited liability partnership, provided that an individual shall not be capable of becoming a partner of a limited liability partnership if A. He has been found to be of unsound mind by the competent court and finding is in force. B. He is an undischarged insolvent. And next, he has applied to be adjudicated as an insolvent. He has applied to the court to be adjudicated as insolvent and his application is pending. So three cases. Who can't be a partner in an LLP? If any person is of unsound mind, he is an undischarged insolvent. He is an insolvent but still undischarged by the competent court. And third, he has applied to the competent court to declare himself as insolvent and the application is still pending by the court. In these three cases, he can't be a member of the LLP. Every limited liability partnership shall have at least two partners. If at any time the number of partners of a LLP is reduced below 2 and the limited liability partnership carries on business for more than 6 months, while the number is so reduced, the person who is the only partner of the LLP during this time, that it so carries on business after those 6 months and has the knowledge of the fact that it is carrying on business with alone himself, shall be liable personally for the obligations of the limited liability partnership incurred during that period, but after 6 months. I believe you understood. Next is distinction between an ordinary partnership firm and an LLP, limited liability partnership. What is the distinction between the two? First, applicable law. To a normal partnership, the Indian Partnership Act 1932 is applicable. For LLPs, the Limited Liability Partnership Act 2008 is applicable. Registration. Registration is optional in case of normal partnership. For LLP, registration is compulsory with registrar of companies. Creation. Normal partnership is created by an agreement between the partners. LLP is created by law. Normal partnership is not a body corporate. Limited liability partnership is a body corporate. Normal partnership is not having separate legal entity from its members. LLP is having separate legal entity from its partners. In a normal partnership, perpetual succession. Partnership do not have perpetual succession. But limited liability partnership, it has perpetual succession and individual partners may come and go. Number of partners, minimum 2, maximum 50 in case of normal partnership. Minimum 2 in case of LLP, there is no maximum limit in case of limited liability partnerships. Ownership of assets, in case of normal partnership, firm cannot own any assets. The partners own assets of the firm. In case of limited liability partnership, the LLP is an independent entity who can own assets. In case of normal partnership, the liability of partners or members are unlimited. Partners are severally and jointly liable for actions of other partners, and the firm and their liability extends to personal assets. In case of LLP, the limited to the extent of their contribution towards LLP, except in case of international fraud or wrongful act of omission and commission by the partners. In case of normal partnership, principal, agent and relationship. Partners are the agents of the firm and of each other. In case of LLP, partners are agents of the firm only and not of the other partners. However, in this chapter, the scope of discussion has been restricted to the partnership account as per the Indian Partnership Act 1932 only. Main clauses in a partnership deed. The relation between the partners is governed by mutual agreement known as partnership deed. It should be comprehensive to avoid dispute later on. It is usual, therefore, to find the following clauses in a partnership deed which may or may not be registered. First, name of the firm and the partners. Second, commencement and duration of the business. Third, amount of capital to be contributed by each partner. Next, amount to be allowed to each partner as drawings and the timing of such drawings. The rate of interest to be charged on capital and his loan to the firm and to be charged on his drawings. The ratio in which the profits and losses are to be shared. Profit sharing ratio. Next, whether a partner will be allowed to draw any salary. Any variation in the mutual rights and duties of partners. any variation in the mutual rights and duties of the partners, methods of valuing goodwill on the occasion of changes in the constitution of the firm, procedure by which a partner may retire, and the method of payment of his dues, procedure of retirement of a partner, basis of the determination of executors of the deceased partner, the partner who has died, and the methods of payment for the same, treatment of losses arising out of insolvency of partners, procedure to be followed for settlement of dispute among partners, preparation of accounts and their audit. Next, registration of the firm is not compulsory, it is optional. Registration of the firm is optional, but it is advisable. But it is advisable to register. It is advisable to register the firm, but non-registration restricts the partners or the firm of taking a legal action. Often there is no written partnership deed, or if there is one, it may be silent on a particular point. In that case, the relevant sections of the Partnership Act will apply. If on a point of partnership deed contain a clause, it will hold good, otherwise the provisions of the Act relating to the questions will apply. Rules in the absence of partnership deed. In the absence of any agreement to the contrary, no partner has a right to a salary. In case of, in the absence of partnership deed or no partnership deed, if there is no partnership deed, salary should not be paid to the partner. No partner should get the salary. No interest is to be allowed on capital. No interest is to be charged on drawings. Interest at the rate 6% per annum is to be allowed on partners' loan to the firm, and profits and losses to be shared equally. I believe you understood. So, five things: no partnership salary is allowed, no interest on capital is allowed, no interest on drawing is charged, interest on partners loan is given at the rate of 6% per annum, and profits and losses to be shared equally. Note, in the absence of deed or agreement, the interest and salary payable to partner will be paid only if there is a profit. This means what? This means that interest and salary is an appropriation and it's not a charge. It's an appropriation, it's not a charge. It's not a charge. I believe you understood. I believe you understood till here. Let us continue. Example: A and B commenced business in a partnership on 1st January 2016. No partnership agreement was made, either oral or written. They contributed 40,000 and 10,000 respectively as capital. In addition, A also advanced 20,000 on 1st July 2016. A met with an accident on 1st April 2016 and could not attend the partnership business up to 30th June 2016. The profits of the year amounted to 50,600. Disputes having been arisen between them for sharing of profits. A claims, first, he should be given an interest at the rate 10% per annum on capital and loan. Second, profit should be distributed in the proportion of capital. My dear students, read in the first line, in case of no partnership agreement. How you will solve this? Next, B claims net profit should be shared equally. Second, he should be allowed a remuneration of 1000 per month during the period of A's illness. Third, interest on capital and loan should be given at the rate 6% per annum. Interest on capital 6% per annum and interest on loan is also 6% per annum. You are required to settle the dispute between A and B and distribute the profits according to the law. Law in the sense the Partnership Act 1932. State reasons for your answers. Answer. Since there is no partnership agreement or oral partnership agreement, no partnership, no means no written agreement and no oral agreement. Following rules are applicable as per Indian Partnership Act 1932. No interest is to be allowed on capital. 6% interest is to be allowed on loan advanced. Profits and losses should be shared equally. No remuneration is given to a partner who is taking part in the conduct of the business. Thus, neither A nor B will be allowed for interest on capital. 6% interest will be allowed to both A and B for the loan. Profit and losses shall be shared equally between A and B and no remuneration shall be allowed to B. I believe you understood. Next example. A, B and C are partners in a firm sharing profits and losses in the ratio of 2:3:5. Their fixed capital were 15 lakh, 30 lakhs and 60 lakhs. For the year 2016, interest on capital was credited to them at the rate 12% instead of 10%. Pass the necessary adjustment entry. So there is an error in this case. Interest on capital is to be given at the rate of 10%, but we have actually credited at the rate of 12%. We need to pass necessary adjustment entry for the same. Interest that should have been credited at the rate 10% is 1,50,000. 15 lakhs multiplied by 10 lakhs is 1,50,000. 30 lakhs multiplied by 10% is 3 lakhs. 60 lakhs multiplied by 10% is 6 lakhs. 6 lakhs plus 3 lakhs plus 1,50,000. The total is 10,50,000. Interest already credited at the rate 12%, this is wrong, is 15 lakhs multiplied by 12% is 1,80,000. 30 lakh multiplied by 12% is 3,60,000. 60 lakh multiplied by 12% is 7,20,000. So interest already credited is 12,60,000. This means we have credited 2,10,000 more. This 2,10,000 is to be distributed in the ratio of 2:3:5. So 2,10,000 multiplied by 2 by 10 is 30,000. Excess credit given on account. So excessively we have given 30,000. 1,80,000 minus 150 is 30. 3,60,000 minus 3 lakh is 60,000 extra. 7,20,000 minus 6 lakh is 1,20,000 extra. I believe you understood 30,000, 60,000 and 1,20,000, that is 2,10,000. Now this 2,10,000 which we have given the excess credit to partners, by recovering the extra amount paid, we have paid extra amount to the partners, we will recover this 30,000. But whenever we will recover this 30,000, 60,000 and 1,20,000, the firm will recover 2,10,000. This 2,10,000 the firm will recover should be distributed in a profit sharing ratio, because this will increase the profit by 2,10,000 and profit to be distributed in the ratio. Profit sharing ratio is 2:3:5. So 2,10,000 multiplied by 2 by 10. Quickly do it on your calculators. 2,10,000 multiplied by 2 by 10 is 42,000. 2,10,000 multiplied by 3 by 10 is 63,000 and 2,10,000 multiplied by 5 by 10 is 1,05,000. So this 2,10,000 would be distributed in this ratio. This is profits. So we need to give profit of 42,000 to A and we need to take back 30,000 of excess interest given. So net effect is 12,000 should be given to Mr. A. 3,000 is to be given to B and 15,000 is to be taken back from C. So the necessary entry would be C's account would be debited and A's account would be credited and B's account would be credited. C's capital account debit 15,000 to A's capital account 12,000 to B's capital account 3,000. I believe you understood this example. Let us move ahead. Next is powers of partners. Powers of partners. The partners are supposed to have the power to act in certain matters and do not have such powers in others. In other words, unless a public notice has been given to the contrary, certain contracts entered into by a partner on behalf of partnership, even without consulting other partners, are binding and the provision of the act relating to the question will apply. In case of trading firm, the implied powers of partners are the following: buying and selling of goods, receiving payments on behalf of the firm and giving valid receipt, drawing checks and accepting and endorsing bill of exchange and promissory note in the name of the firm, borrowing money on behalf of the firm with or without pledging the inventories in trade, engaging servants for the business of the firm. In certain cases, an individual partner has no power to bind the firm. This is to say, the third parties cannot bind the firm unless all the partners have agreed. These cases are: A. Submitting a dispute relating to the firm arbitration, opening a bank account on behalf of the firm in the name of the partner, compromise or relinquishment of any claim or portion of the claim by the firm, withdrawal of a suit or proceeding filed on behalf of the firm, admission of any liability in a suit or proceedings against the firm, acquisition of immovable property belonging to the firm, entering into partnership on behalf of the firm. The rights and duties and powers of the partner can be changed by mutual consent between them. Accounts. Next topic is accounts. Partnership Act does not specify any format for preparation of accounts of partnership firm, and thus accounts are prepared as per the basic rules of accounts. There is not much difference between the accounts of a partnership firm and accounts of a sole proprietorship, provided there is no change in the firm itself. The only difference is to be noted is one, that is capital account. There will be as many capital account as there are partners. If, for instance, there are 3 partners, there would be 3 capital accounts, capital account of A, B and C, and there will be a capital account for each one of the partners. A's capital account will be credited by the amount contributed by him as capital, and similarly B's and C's capital account will be credited with the amounts bought in them respectively as capital. When partner takes money out of the firm for his domestic purpose, either his capital account can be debited or a separate account named as drawing account can be opened in his name, and the account may be debited in a trial balance of a partnership firm. Therefore, one may find that the capital accounts of partners as well as drawing accounts, finally, the drawing accounts of a partner may be transferred to his capital account so that the net figure is available. But often the drawings account and the current account, it is usually called, remains separate. Next is profit and loss appropriation account. Why this account is prepared? What is the need of it? During the course of business, a partnership firm will prepare trading account, profit and loss account at the end of every year. The final account of sole proprietorship concerns will not differ from the accounts of a partnership firm. The profit and loss account will show the profit earned by the firm or loss suffered by it. This profit and loss has to be transferred to the capital accounts of partner according to the terms of the partnership deed or according to the provisions of Indian Partnership Act. If there is no partnership deed or if the deed is silent on a particular point, suppose the profit and loss account reveals a profit of 90,000. There is two partners A and B. A devotes all his time to the firm, B does not. A's capital is 50,000 and B's capital is 20,000. There is no partnership deed. In such a case, the profit will be distributed among A and B equally because there is no partnership deed. This is irrespective of the fact that B does not work as much as A has worked for the firm. B's capital is much less than that of A, but in the partnership deed lays down that A is to get a salary and interest is to be allowed on the capital. Then first of all, from the profits earned, A's salary must be deducted and interest on the capital accounts of both the partner will be deducted. The remaining profits will be divided equally between A and B. Further, if the partnership deed says that profits is to be divided in the ratio of 3/4 to A and 1/4 to B, 3/4 to A and 1/4 to B, then this will be in the ratios to be adopted. But we need to decide it before in a partnership deed. In a partnership, profit has to be divided between the partners in a certain profit sharing ratio after making the necessary adjustments stated in a deed, partnership deed, such as interest on capital, the drawings, loans, salaries, commission to partners, etc. Accordingly, an additional account is prepared and net profit is transferred to the debit side of the profit and loss account to the credit side of new account, which is called profit and loss appropriation account. And before the profit is divided between partners, it is necessary to record the profit stated adjustment in this account. The student can see for himself that if a salary is to be allowed to the partner, the profit and loss appropriation account will be debited and the partner's capital account will be credited. Similarly, if interest is to be allowed on capital, the profit and loss appropriation account will be debited and the capital accounts will be credited. Let us take an illustration to understand how to divide profits among partners. Illustration: A and B start business on 1st January 2016 with capitals 30,000 and 20,000. According to partnership deed, B is entitled to a salary. B is entitled to a salary of 500 per month and interest is to be allowed on capital 6% per annum. So interest on capital is 6% per annum. The remaining profits is to be distributed among the partners in the ratio of 5:3. The profit sharing ratio is 5:3. During 2016, the firm earned a profit before charging salary and B interest on capital amounted to 25,000. So out of this 25,000, we need to pay salary to B and interest on capital. After that, whatever the profit is remaining, we need to distribute the remaining profits in the ratio of 5:3. During the year, A withdraw withdraw rupee 8,000 and B withdraw 10,000 for domestic purpose. So these are the drawings of A and B. Give journal entries relating to division of profits. Solution: B is to be given a salary, so B's salary is 500 per month. So 500 multiplied by 12 months equal to 6,000. This is B's salary. Interest on capital is also allowed. So interest on capital is calculated at the rate 6% per annum. We'll calculate interest on capital for A. So 30,000 multiplied by 6%, 30,000 multiplied by 6%, 1800, and 20,000 at the rate 20,000, 6% is 1200. So this is interest on capital, and accordingly the profits is to be distributed. Profits of the firm, profit before charging salary and interest on capital is 25,000 less salary, B's salary 6,000 less interest on capital A and B 1800, 1200, that is 3,000. So 25,000 minus 6,000 minus 3,000 is the remaining profit is 16,000. This profit needs to be distributed between partner A and B in the ratio of 5:3. Profit distribution to A, it is 16,000 multiplied by 5 by 8, 10,000. To B, it is 16,000 multiplied by 3 by 8, 6,000. Now we can journalize it. Journal entries. Date, particulars, debit amount, credit amount, year end 31st December, profit and loss appropriation account, debit to B's capital account, $6,000 for salary, next profit and loss appropriation account, debit to A's capital account, to B's capital account, $1,800, $1,200, $3,000. for the distribution of profit. Third entry, profit and loss appropriation account, debit to A capital account to B's capital account. $10,000 and $6,000, total $16,000. I believe you understood. I believe you understood this. Let us continue. Illustration 2. Illustration 2. Ram, Rahim and Kareem are partners in a firm. They have no agreement in respect of profit sharing ratio, interest on capital, interest on loan advanced by partner and remuneration payable to partner. In a matter of distribution of profits, they have put forward the following claims. Claim 1. Ram, who has contributed maximum capital, demands interest on capital at the rate 10% per annum. And share the profits in capital ratio, but Rahim and Kareem do not agree. Next, Rahim has devoted full time for running the business and demands salary at a rate of 500 per month, but Ram and Kareem do not agree. Kareem demands interest on loan at the rate 2000 advanced by him at 12% per annum. How shall you settle the dispute and prepare profit and loss appropriation account after transferring 10% of the divisible profits to reserve? 10% of the profits is to be transferred to reserve compulsorily. Net profit before taking into account any of the above claims amounted to 45,000 at the end of the first year of their business. I believe you understood. Solution. Solution. Since there is no partnership deed, the following provisions of the Indian Partnership Act are to be applied to settle the dispute. You can write, since there is no partnership deed, first, no interest on capital is payable to any partners. No interest on capital is to be payable to any partners. Therefore, Ram is not entitled to interest on capital. Next, no remuneration is payable to any partners, Therefore, Rahim is not entitled to any salary, Third, interest on loan is payable at the rate 6% per annum. Therefore, Kareem is to get interest at the rate 6% per annum on rupee 2000 instead of 12%. Karim demanded for 12%, but 6% per annum is allowed. 12% is not allowed. Next, the profits should be distributed. The profits should be distributed equally. The profits should be distributed equally. Now let us prepare the profit and loss appropriation account. Profit and loss appropriation account. Profit and loss appropriation account. Particulars amount. The net profit is given in the question by net profit 45,000. Out of this net profit, interest on loan at the rate 6% is to be given to Karim, to interest on loan to Karim. 2000 multiplied by 6%. 2000 multiplied by 6%, 120. In reserves, 10% is to be transferred compulsorily. To transfer to reserve, 45,000 minus 120 multiplied by 10%. So 45,000 minus 120 is 44,880. 44,880 multiplied by 10%, it is 4488. Total is 45,000. This total to be taken here on the debit side. Now this profit is to be transferred between Ram, Rahim and Karim equally. Share of profits. Share of profit, Ram, Rahim, Karim. 45,000 minus 120 minus 4488, 40392. 40392 multiplied by 1 by 3, 13464. 13464. 13464. 13464. This profit is to be distributed equally between Ram, Rahim and Karim. I believe you understood. Let's move ahead. Illustration 3. A and B starts business on 1st January 2016 with capitals of 30,000 and 20,000. According to partnership deed, B is entitled to a salary of 500 per month and interest on opening capital is allowed at the rate 6% per annum. The remaining profits is to be distributed in the ratio of 5:3. During 2016, the firm earned a profit profit before charging salary to be an interest on capital, that is 25,000 during the year. A withdrew 8,000 and B withdrew 10,000 for domestic purpose. We need to prepare profit and loss appropriation account. I believe you understood the question. Let us begin. Solution. Preparation of profit and loss appropriation account. Write profit and loss appropriation account. Profit and loss appropriation. Profit and loss appropriation account for the year ended on 31st December 2016. Particulars, amount, particulars, amount. By net profits. Net profit is given in the question, that is 25,000. We need to deduct B's salary and interest on capital from this first. So to B's capital account for salary 6,000, 500 multiplied by 12. 500 multiplied by 12, 500 per month. Next is to interest on capital, A and B. For A, the capital is given in the question 30,000 and B 20,000. So 30,000, 20,000 multiplied by 6%, 1,800 and 1,200. 1,800 and 1,200. Now we need to calculate the share of profit. Total is 25,000. 25,000 minus 3,000 minus 6,000. 16,000. To share of profit. Profit transferred to A's capital account, B's capital account, in the ratio of 5:3. So 16,000 multiplied by 5/8, which is 10,000, and 16,000 multiplied by 3/8, which is 6,000. I believe you understood. This. Write a note over here. Since date of drawing and interest on drawing is not given, it is assumed drawings are made on last day of the year. I believe you understood this. Illustration 4. We are starting with illustration 4. The question is same, we need to prepare capital accounts of A and B. The question is same as illustration 3, but here we need to prepare capital accounts of A and B. I still go through the question once again. A and B starts business on 1st January 2016 with capitals of 30,000 and 20,000. According to the partnership deed, B is entitled to a salary of 500 per month. The interest is to be allowed on opening capital at the rate 6% per annum. The remaining profits is to be distributed in the ratio of 5:3. So profit sharing ratio is 5:3. During 2016, the firm earned a profit before charging salary to B and interest on capital, that is 25,000. During the year, A's drawing is 8,000 as B's drawing is 10,000. Prepare capital accounts of partner A and partner B. Solution. Solution. A's capital account. A's capital account. First of all, we are preparing the capital account separately. Date, particulars, amount. 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 Debit, credit. We'll begin with the capital introduced on 1st January by bank. 30,000. Now December 31st, by profit and loss appropriation account. Profit and loss appropriation account. Interest on capital. Interest on capital is allowed 1800. We have calculated 1800. 30,000 multiplied by 6%. 30,000 multiplied by 6%, 1800. Profit, the share of profit by profit and loss appropriation account. Share of profit. $10,000. Share is 5/8. Drawings made, and we had assumed the drawings is made on the last day. To bank account. To bank account drawings. Drawings 8,000. 30,000 plus 1,800 plus 10,000 totals 41,800. 41,800 is to be taken on the debit side, the total, minus 8,000. To balance carried down. To balance carried down 33,800. I believe you understood. So this was A's capital account. We are preparing the A's and B's capital account separately first. Now we are preparing B's capital account. B's capital account. Date, particulars, amount. Date, particulars, amount, debit, credit, date, particulars amount, date, particulars amount. January 1st, by bank account, the introduction of capital 20,000. Then last day of the year, 31st December, salary for the year, to profit and loss appropriation account, salary 500 per month multiplied by 12, so 6,000, and interest on capital, capital is 20,000 multiplied by 6%, so 1200. Share of profit by profit and loss appropriation account, share of profit is 6,000, we have calculated 6,000, 3 by 8. On the last day, drawings, December 31st, to cash, bracket drawings, 10,000, to cash drawings, 10,000. Let us do the totals, 20,000 plus 6,000 plus 1,200 plus 6,000, 33,200. 33,200 to be transferred to the debit side, total minus 10,000, closing figure 23,200. To balance carried down. The closing balance of B's capital account is 23,200. I believe you understood. This. We are keeping it till here. Thank you.